The money markets remained liquid with active market operations, which saw the interbank transactions reduce from a high of 52 transactions to a new low of 20 transactions for the period under review. And that also saw the volumes drop from 32.4 billion to 11.4 billion, with it pushing up the rate from a low of 9.48% to a 9.58%. Welcome to our today's video. We are reviewing the top 10 money market funds because money market funds remained the preferred vehicle for investments and savings by a majority of investors in the collective investment schemes, including the special funds, with the Q2 report by the Capital Markets Authority reflecting that money market funds are taking up over 65% of the total assets under management in the collective investment schemes. Using this schedule of the top 10 money market funds, in the top 10 list, we have Saiton money market funds with an annualized return of 13.12%, GAFCAP taking position 2 with a return of 13.11%, Ndovu Money Market Fund, which is registered as Taifa Unit Trust Scheme, as a 13.06%, Nabo Capital as 12.89%, Loft Coban in position 5 as a 12.39%, and Etika Money Market Fund giving a 12.15%, Orient Kasha in position 7 giving us a 12.12%, Avocap as a 12.11%, Kuza Money Market Fund at 11.75 in position 9, and closing the top 10 list in performance of the money market funds for the week under review is Gen Africa Money Market Fund at 11.29%. Those annualized returns, when adjusted for withholding tax at 15%, will give us the net returns in the second column, with the top money market fund, that is Saiton MMF, will be giving us a net return of 11.19%, GAFCAP 11.4%, down to number 6, Etika, giving us a net of 10.33%, and Kuza at number 9, giving us a 9.99%, and at the number 10 in the top 10 list, that is Gen Africa Money Market Fund, giving us a tax-adjusted return of 9.60%. At that point, is important we now look at the market interest rate as given by the 364-day Treasury bill, where during the week under review, the 364-day Treasury bill posted a 9.5790% as the gross return, translating to a 9.58 rounded up to 2 decimal places, and adjusting that rate with the withholding tax rate of 15%, which is giving us a 1.44%, we are left with a tax adjusted market interest rate of 8.14%. Why is this important? One of the promises from money market fund investing on and above security of the invested capital and preservation of the capital, money market funds have an objective of giving the investors a return that is not only inflation beating, but a return that is above what the investor can get from the money market instruments. These are the short-term instruments, including the treasury bills. We have bank deposits, call accounts, and that's why majority of the money market funds, their benchmark rates is the average return of a 91-day treasury bill plus a 1%, while some give benchmark on the 91-day treasury bill average return without any additional percentage. But it's important as an investor to always take note of the investment objective of your particular money market fund. And in this case, if you look at this objective extracted from the Etika Money Market Fund, the investment objective of the Etika Money Market Fund is to obtain a high level of current income while protecting investors' capital. The fund aims to outperform the income yield available on money market instruments and fixed deposit accounts by holding diversified portfolio of securities. So as an investor, while choosing where to put your money and the continuity of whether you should continue holding your funds or investment in that particular investment vehicle, it is important also to align with the objective or evaluate whether the fund manager has kept his part of bargain by giving you a return that is not only beating inflation, but also a return that you are unable to get from the short-term instruments if you are to do it as a DIY. And that speaks to the rest of the money market funds. If the tax adjusted market return is at 8.14%, then that would be one of the minimums acceptable by an investor when going for a money market fund. You need to be investing in one that is giving you at least 8.14% as the net tax adjusted return. The next important item to consider is the question of inflation. Inflation being the general changes in prices of commodities in the market. In investing, any investment qualifies for that tag of an investment if the return is inflation beating, if the return is way higher than the current inflation rate. Sometimes it's good we go by the average inflation rate other than the period in inflation. For example, in the week under review, the inflation rate for this month has been 4.5%, but taking an average of the previous months, the inflation rate will be different from that figure, and it's always given that it's good to use a little bit higher rate, preferably between 5% to 6%, to determine your real return. Using the 4.5% as the inflation rate, adjusting the net returns from the top 10 money market funds, Cyton in number 1 will leave us with a 6.65%. We have GovCap in position 2, leaving us with a 6.64%, all the way to number 6, Ethica, leaving us with a 5.83%. Orient Kasha in number 7 will leave us with a 5.80%. And number 10, we have Gen Africa, which will leave us with a 5.10% as the real return or real growth in the capitals invested after adjusting for both taxes and inflation. Another element that is important to consider during investment, and especially because investment is a capital expenditure decision which would require evaluation of available opportunities and ranking them in terms of their returns, then allocating the available capital to the ranked options until that capital is exhausted in an effort not only to diversify the investment, but also to maximize the returns, the average returns from the portfolio constructed. In this case, we arrive at the element of opportunity cost. And opportunity cost in your investment is the return that you forego from the second alternative in order to go for the option that you choose to put your money into. And in the case of money market funds, your opportunity cost that you're supposed to consider in your evaluation would be the return that you have foregone from the second best options in your choice. In this case, if you are holding your investment in a non-inflation beating return, then we not even need to look at the opportunity cost in that case. But in the case of opportunity cost, you look at the options of other money market funds, preferably that are giving you a return way higher than what the money market funds where you are putting your money, and treat that one, the difference, as another column for adjustment to get your real return, to get your real performance. Because opportunity cost is one of the main costs that are left out by many investors during the analysis or evaluation of performance of their investments. Flexibility is the power in the hand of the investor, because money market funds, their returns will always be fluctuating. And the features And because of the qualities or the attributes of these investment vehicles, they give you an opportunity to chase the return by flexing your investments, pushing your investment towards vehicles that are going to be giving you a return that is way better than what you're getting from your current fund. There are also other factors to look for when deciding where to put your money. You cannot trade your good customer experience from your current fund manager in exchange for a slightly higher performance, but a watered down experience as an investor. We shall be looking at the performance of the fixed income funds and how you can leverage on them to make a better return in our next video. Thank you for watching and see you in our next video.